Hi friends, in today's topic, we are going to talk about are you overpaying for your insurance? So let's dive into this. First of all, I think it's very helpful to look at this. MES came out with a basic financial planning guide, and in this guide, they share with us on the insurance element, which is how much death coverage do we need to, which is 9 times of annual income, how much critical illness insurance do we need, which is at least 4 times of your income. And of course, there are some other things like the MediShield, CareShield insurance, but they didn't really touch on a few other things, which is the upgrade for disability insurance, private healthcare for medical insurance, and I think one more part is the accident insurance, which they did not cover. But the main thing over here is that you will notice the recommendation itself, right, is spend at most 15% of the income. And we want to find out a bit more on this. And of course, they talk about if you actually invested with whole life insurance, what happened itself is that it may exceed 15% of the income because a life plan generally is more expensive compared to pure insurance, which is term insurance. Okay, so let's go into this. So let's talk about the essential things that you need first, so we can break down on how much does a total cost looks like for a person having an insurance in Singapore. So the first thing that you need to take note is you want to cover your hospital expenses in the situation that you fall sick, because hospital expenses are crazily high in Singapore and it's super expensive. And if you do not have any insurance element over here, likely it will be a very huge chunk out of your own pocket. And the second insurance that you need is you want to ensure that your income can be replaced, meaning insurance that pays you a lump sum if death, total and permanent disability, or terminal illness occurs. So this is the second important part, which in the MES planning guide they did mention also, which is at least 9 times of income. And the third part is you want to replace your income if critical illness or early critical illness were to strike. So when I mention replace your income, it does not mean a monthly payout. It's more of like a lump sum payout if let's say critical illness or early critical illness strike. And the fourth thing that you need to have, which I think they did not mention in the guide, is accidental insurance. That means, right, if let's say any insurance that pays you due to accident. So let me quote you an example, so at least we understand why is this important in your plan. If we were to have all the above coverage, which is this, okay, the hospital insurance, a term insurance that covers death, TPD, TI, and CI. Okay, what happens itself is that we want to ensure that the person's income is protected. But however, if we are talking about total and permanent disability, let's quote an example in a situation. A person who is working and then an accident happened. So in the accident itself, right, he have to amputate one of his limb. And if one limb were to be amputated, will he still be certain that his future income will be the same as in his previous job? This is going to be a big question mark. This is going to be a big question mark. Because if let's say his job requires a lot of physical activity, he might not get back the same job anymore. And of course, it might be an office job, but then office job, will he be able to be 100% certain that he's able to get back the same job again? So this is a big question mark. And accidental insurance helps to cover that, because total and permanent disability covers, meaning like they only cover if let's say if you have a loss of like both limbs, in terms of like 2 arms or 2 legs, things like that, meaning very drastic situation. But accidental insurance can cover even, let's say, if the person, due to accident, they actually lose 1 limb. And that itself will also have a payout. So this is pretty essential, I would say, in the portfolio also. And then let us add this in also. Okay. And the last one is actually disability insurance. So disability insurance is, let's say, if total and permanent disability occurs, the person is not able to work. And hence, if let's say if he has an income replacement, a lump sum paid out to him, then why is it we still need this disability insurance? The disability insurance is to ensure that the additional expenses that the person will incur, the majority of the expenses, we hope that we are able to expense it through the paid out over here, which is generally they pay out every single month. Then this itself is to ensure that the person's lifestyle still remains the same. So there's a slight difference and nuance into it, But if we are talking about comprehensive planning for a client's portfolio, these 5 factors itself will be essential. So let's go into the next slide. Let's use a case study to explain. And the case study itself will be a 35 male non-smoker earning 6,000 a month. Okay, so let's talk about first thing first is how much insurance he needs. If we are talking about hospital coverage, if he wants to have the most comprehensive coverage covering up to private hospital, we're going to do that. And then death coverage, we follow the guideline, 9 times of annual income. So basically 9 times 6,000 times 12. So this is the amount that he needs. Early critical illness and critical illness, basically the recommendation 4 times of his annual income. So we're going to take this amount times 4, it will be 288,000. Accidental coverage, we also use, assuming let's say if something happened, we also use the full 9 times as a coverage amount. And then disability coverage, right, to cover at least 3,000 a month. Because studies have shown that, let's say someone were to be disabled with all the expenses to pay for help, healthcare, and then in terms of like nursing, the amount itself generally it will lead to around 3,000 per month for this period of time. However, of course, we haven't really taken inflation into accordance, but we will use this as an example for now. So let's talk about the first thing, hospital insurance. So for hospital insurance, if the person is at 35 years old, he would already have this thing, which is the MediShield Life. So this is already expensed out from his CPF MediSave. However, if he upgraded his insurance, so looking at this, his annual premium will be $360 a year. So if he upgraded his insurance to a private hospital, he just have to fork out $360 a year and he will be able to enjoy a more comprehensive hospital insurance coverage. And out of these 360, right, 300 can be deducted by MediSave. So the next thing, a lot of insured will add on what we call a rider into the plan. Because a rider itself, right, the main idea, maybe I will cover this in the next video. If let's say this is something that you'll be interested in and want me to explain a bit further. But today, I'm just want to talk about the cost. So this rider, generally, the main objective is when you add this in, you want to minimize your out-of-pocket risk. Because even if you have a main plan, your out-of-pocket risk is still high because there's a co-insurance of 10% that you have to pay. But generally for all the insurers in Singapore, if you have add on a rider, they will limit the out-of-pocket expenses. So looking at this, the annual premium is $394 a year. So the total cost will be $360 plus $394 and that would have add up to $754 a year. However, $300 can be deducted by MediSave and we're going to minus the 300 out. So today we just talk about the cash outlay. So cash outlay will be $454 a year. So the next thing, let's cover the second point and the third point together, which is the cost of term insurance plus the early critical illness rider. So the term insurance, according to his income, we need to cover it for $648,000. Term insurance, we need to cover $288,000. But however, early critical illness generally in terms for the companies, they only have a maximum payout of up to $250,000. So we're going to use the $250,000 over here and we add on a critical illness rider of 50. So this itself will be 300K. Okay. So this 300K will be slightly higher than what he needs at 288,000. And the reason being is that because for this insurer, we can't really push this 50,000 into just 38,000. So we just have a slightly higher amount. So assume the coverage is up to 70 years old. The premium required is $3,233.05 a year. So this is the premium required to cover death, TPD, TI, and ECI, plus a bit of CI. So the cost of accidental coverage. So this is the next part that we wanted to cover the 648,000, 9 times of his income. But however, no accident plan cover a la carte amount, meaning they don't cover in terms of like amount exactly what clients need. And they cover in terms of like a plan 100K, like for example 100,000, or they cover like for example 500,000. So everything goes in like a full figure. And I generated 2 plans. One plan covers 300,000, assuming let's say if the insured lost a limb, they will have a payout of 300K. And I also generated another one, a plan B, that covers 750,000. And this itself will be higher than this amount also. So I don't have an exact amount, but I try at least we can see the differences. And premium difference itself, right, for plan A and plan B will be 288 per year or 468 per year. And the last thing that we want to cover is the cost of disability insurance. Assuming the intended coverage is 3,000 a month, and the client want to cover, let's say, out of the six daily activities he can do, which includes like washing, change of clothes, feeding, things like this. As long one of it he can't fulfill, they will start to pay up 3,000 a month. And I generated the premium, and it seems like the premium is about 1,107.09 per year. So out of this amount, $600 can be deducted by MediSave. So in today's case study, I just want to find out regarding about the cash amount needed. So taking this minus 600, this is the cash outlay required to cover disability insurance for 3,000 per month. This is the yearly amount. So we are come to the total of everything, and if we add up everything in the cash component, the total amount would have been 4,662.74 per year. And it's a pretty comprehensive coverage covering everything linking from hospital, term insurance, critical illness to accident and disability. And this will be the total premium. So if we were to look at the person's income, which is the insured income is 6,000, male non-smoker, after CPF, right, he would have a 4,800 take-home pay. And annual income of 4,008 times 12 will be 57,600 per year. And the cost of insurance proportion to the income is, taking this divide by this cash component, is only 8% of income. So you don't really have to fork out until up to 15% of the income for insurance. You can even do so at a much lower amount. And this amount itself still included accidental coverage and disability coverage. And of course, the term insurance is also, we are covering early critical illness, which is also more expensive compared to critical illness coverage, because critical illness coverage only covers up to advanced stage critical illnesses. And early critical illness cover covers all stages of critical illness, and hence it is more expensive. There are a few takeaways over here, and I think the first thing is, first of all, to get a very comprehensive insurance coverage done up for your portfolio, what happened itself, right, it doesn't take up a lot from the income. And this is a pretty comprehensive one because I basically ensure that all elements of his portfolio are covered, and we only take up 8% of the person's income. And the second part is, if let's say this is based on the portfolio who is someone at 35 years old, what if he would have started in 25? The amount itself will be much lesser because the insurance premium will be much cheaper. And for your insurance much earlier, if you have already started, it is great. But however, if let's say if you have not started, do it now and don't wait, because the longer you wait, the more expensive it is, and this portion itself will also start to go up if let's say you decided to do up your insurance policies at a much older age. I hope you have gotten value out of this video today, and subscribe to this channel if you enjoy content like this. I'll look forward to talking to you in the next video.